Hear ye, hear ye. It is our honor to welcome you to the KingMaker Podcast.
That's okay. These things happen. We're all here now. How's it going today, Sam?
I'm doing great. Thanks, man. Congrats on you guys launching Volt. I minted my first Volt, and we've been waiting for you guys on mainnet. So all the FPI holders have been waiting. So now we can finally do the awesome, pegged deep liquidity.
Yeah, it takes two to tango, right? So that's fun. It's really great. Like all the other dollar stable coins don't know how good they have it with, right? So it's really important to have a shared standard, and I'm excited to talk about that with everyone today.
Yeah, exactly, and it's pegs are Schelling points, right? So they're Schelling points on monetary policy. So I think people will start seeing that, as more and more people try these CPI pegged stablecoins.
Absolutely, because it's really just been so normalized that the government gets to suck up, 2+% of the whole economy, kind of as a backdoor tax of inflation, and so this is an opt-out.
Exactly.
Awesome. Well, let's get started. Again, sorry for the technical difficulties there. Our first spaces kicked us. So great to have Sam from Frax and Kirk from Volt on the KingMaker podcast. Alejandro, when we were setting this up, I still didn't sort of believe that we really were going to have these two gentlemen on today, and it is great to have these kind sirs. We are going to put this out as a podcast later today. So if you missed the spaces because of broken links or whatever the scenario is, we'll have it out there. And just to plug a couple other things happening soon, we're going to have a interview podcast out Monday with the gentleman from Redacted. We have Sammy and we have PP Moon 69 KP on that show. And then on Thursday, we're going to put out a podcast with AJ from Silo. And he wanted me to tell Sam and Kirk hello. So everybody's always looking to collaborate. Alejandro, I see you're here. Thank you for joining in as well. Sorry for the mishap with the spaces there earlier.
No, hello everyone. It's really nice to be here. It's really nice to meet you guys. Also want to apologize. I clicked in on the sim account and I ended it by accident, so it was my fault. It was like a weird glitch. But yeah, it's really nice to meet you guys. I've been looking into your white paper and been following the development, and it's really nice to have you guys clarify everything to the community.
Awesome. Well, let's get rolling. Without further ado, stablecoins. It is stablecoin season. We have Forpool. We have inflation protection with stablecoins now, with what we're going to talk about with FPI and Volt. Volt has launched. It's exciting. And without further ado, let's kick it y'all's way. What are we trying to solve? What's the origin story for Volt? I see Volt has a lot of connections with Olympus, with Frax, with other the folks over there at Fay. Fill us in. What's this journey been like, Kirk?
Well, I think what Sam and I agree on the most deeply is being stablecoin maximalists, in that the vision of crypto as money is money that's outside of the control of a state, that is censorship resistant, permissionlessly usable by anyone in the world, peer to peer, and freely composable into novel financial instruments. The thing is that is just fundamentally mutually exclusive with a volatile asset, and that is my belief. And that those assets can be very valuable assets and have strong monetary properties, but they're not suitable for you're not going to, your small business doesn't want to take a loan in ETH or Bitcoin no matter what, right? That just doesn't make sense if the value of their loan can spike. You need a stable asset for credit markets, lending and borrowing, and for lots of real world things. And so far, the best currency in the world for a long time has been the US dollar, because it was the most liquid and relatively stable. But the stability has been under question, and there's lots of other disadvantages. And so we see like USDC taking over the world, right? Because they're like the simplest form of a tokenized dollar. and other decentralized stablecoins are all kind of coming after that of, what can we offer that's better than that, whether it's, more censorship resistance or higher yields. There's a lot of different ways that they try to compete and different risk profiles. But that's how I would kind of summarize what I see as the big situation in the space. And very soon stablecoins will have a multi-trillion-dollar market cap. It's just in the stablecoins, not in the governance tokens. That's a whole separate thing.
And Sam, from your perspective, what are you trying to solve as well? What's your vision here?
Yeah, I mean, Kirk said it well. I think I was one of the first people to be, I think, both called a stablecoin maximalist, but also kind of embrace it and try to, take it and make the moniker kind of a meme. I see a lot of things eye to eye with Kirk, but overall, just I said this on the Bankless podcast the other week that I was on, and there's, I think, $3 trillion narratives in crypto, and those three are like BTC, ETH, and stablecoins. And I think a lot of people are starting to believe that because the evidence really points to that. So most exciting, most interesting projects will be stablecoins. And so at Frax, everything we build is part of kind of the Frax economy, Frax ecosystem. So that's why both the Frax dollar peg stablecoin and the Frax price index, they're all part of the same, core kind of underlying protocol. In fact, the structure we take is almost kind of the same structure as an L1, where the Frax share token is the L1 asset that somehow can accrue value from everything else that's kind of built on top of it. And FPI is the second stablecoin that's built inside of the Frax economy. Now, I think we'll get to this more and more as kind of this talk goes on. But one thing that's important to clarify and also discuss is that with the final vision of kind of the FPI, and I think Kirk will agree with me with Volt here as well, is to be able to actually have the global digital crypto economy define its own definition of stability, right? And what the actual things or consumer items or things that are important to us are, and how to actually build a currency that's pegged to those things. Right now, we obviously use the U.S. government's definition of the CPI. Obviously, that means that the inflation rate that's currently reported is 8% or whatever, and there's a lot of disagreement about that, right? One of the most commonly asked questions, other than how do you make sure that your collateral base grows with CPI, the second most commonly asked question for the FPI, at least, which I assume with Kirk as well, is inflation is not really 8%, or how do you know it is, or something like that. And the answer to that is, well, we don't, right? Obviously, we want to peg to the current Schelling point of inflation. When people talk about inflation, they literally mean that reported rate. In fact, when you say the sentence, isn't inflation higher? The word inflation refers currently to the Federal Reserve's 8%. Otherwise, you wouldn't be able to coherently say that phrase, right? And so the end goal of what we're trying to do is finally, as a digital global crypto economy, be able to redefine that eventually. But you don't just start with just a really bespoke and off different unit, and then try to have everyone come to you. So that's why we still basically take passively the Fed's definition of inflation and stability, but that's not the end goal, right? So the end goal is a totally new, for once, self-sovereign definition of stability and a new peg.
Absolutely. And one thing that I'm really excited about, just springing off of that, is the idea of then offering supplemental yield denominated in these inflation-resistant stable assets. Because, there's different ways to look at inflation, right? Is it the change in the price of things like steel and food, or is it the change in the price of houses? Because those are very different things. And so the idea is that the most liquid base asset should be around the biggest shelling point that everyone can agree on with inflation, right? And that's CPI today. That's what the Treasury inflation protected securities the government issues are based off of. And that's a multi-trillion-dollar market. Just those types of securities, let alone like. So I think that building a baseline that is not eroding value and is as stable as possible, and then constructing other things on top of that will be very exciting. And we agree that the CPI is the most neutral and credible starting point, and we don't want to rush into any kind of one-off solution, but internationalize in a systematic way in the future.
Okay, well, take us to the base layer of what Volt is all about, the protocol. As I was reading through your white paper and trying to wrap my brain around it, explain to us as, what it reads is an over-collateralized, inflation-resistant stablecoin. Is that a good summary, or how would you describe your protocol?
That's absolutely right. Well, there's two sides to the Volt coin. One is the Volt stablecoin itself, which is very like in terms of its high-level design and risk model, MakerDAO's DAI, and that it can be issued both through a PSM, peg stability module, where users deposit stablecoins to swap directly with the Volt at the current target price or redeem it. And then it could also be minted into Fuse or other lending markets and issued as debt with over-collateralized user positions. That feature is currently not live, but will be next week. So right now it's only PSM minting. However, the other side of the coin is how governance will work in Volt. And actually, I think it's Joey who said to me, V2 is always V1. Whatever you ship as the V2 is what the founder originally set out to build with their goal. And what I'm really excited to share about also is the idea of market governance. And this is inspired to an extent from things like the V token gauge model, but with some differences. Essentially, Volt seeks to allow liquid real-time allocation of the PCV amongst whitelisted yield venues. And it's based on combining some of the ideas from Curve and Fei Turbo around permission borrowing or access. So we're still working on this, and we're going to be sharing more detailed public things, but you can see a little bit of what we've posted and written about it. The idea being that the VCon token will be a cash flow token, right? That's based on active performance of directing the PCV and getting some performance. So in a way, VCon is like a meta yield aggregator, sort of like in the Yearn space as well.
Excellent. Then Sam, from the FPI standpoint, over collateralized. I saw in some of the documentation it talked about that there's going to be real world assets backing it down the road, but initially minting with Frax, which is an algo stablecoin. How would you describe FPI?
Yeah, it's basically, think of how Frax works, and Frax actually has a pretty high collateral ratio for branded quote unquote algorithmic stablecoins, around 86% right now. FPI is like that, but it's even higher. We're going to target around 100% CR because it is more of a challenging peg to hold, right? Because like I said, one of the first questions is like, how do you actually have the collateral grow to inflation? And I just also wanted to comment on, now that we're talking about collateralization rates and things like that. I was also talking last night, and also just actually recently, right on Twitter, I was talking with Seb from Maker. I want to just comment on the fact that calculating collateral ratios and actually how stablecoins report their assets is very non-standardized, and not in like a bad way or in any kind of like specific way. But like, for example, there's the misconception that if you back part of the supply of a stablecoin with the governance token, that's basically like being an insolvent bank, because it's like equity, right? The governance token is like equity. You can't back it with that. And then there's the misconception that Maker is over collateralized, like 150 or 60% over collateralized, which is actually, in my opinion, not really true. It's Maker is around 100%, maybe sometimes slightly less, maybe sometimes slightly more. And this is actually what I was talking about right before this podcast, for example, is like, if you actually tokenize the CDPs, the over collateralized loans in Maker, those are not worth $150 per like $100 of DAI. For example, if someone comes to Maker right now and they actually put up $10 billion worth of ETH in a CDP, and they just only borrow one DAI, just a single DAI with $10 billion worth of ETH, Maker will report its entire system CR is like 300 something percent. But Maker and DAI are not any safer after that $10 billion of ETH collateral minting a single DAI. In fact, that loan is only worth $1, right? Like that loan with $10 billion of collateral is only worth $1 because the debt is only $1 of minted DAI paying couple percent interest. It might even be slightly discounted under $1 depending on lack of liquidity and like liquidity premiums, right? And so kind of wanted to explain this since we're talking about how stablecoins work or how the FPI works or which mechanism it is or what it is or things like that, is that there's a lot of common misconceptions in stablecoins because there's no standardized ways yet to actually report what's what in stablecoins. And the FPI will work pretty much like Frax, except targeting CR of around 100%, which is actually, I would argue that is actually Maker's CR. And I think once you take a look at it, you actually understand that just like how there's no such thing kind of as like a insolvent bank or so, because there's like part of the supply is algorithmic. I don't think there's any such thing as like an over collateralized model. But that's just kind of my opinion on it.
Yeah, I would actually pretty much agree with everything Sam said there and say that actually I think that almost no stablecoin issuer has sufficient reserves currently, in my opinion. So like with Volt, we're actually going to, in a real bank, right, they would target a 20% reserve where the total amount that they've, they have to have a surplus, an extra to account for losses. And that is something that allows for any loss in a yield venue. For example, like what happens in MakerDAO if they have a liquidations failure? Well, they've got to try and mint and sell Maker. So in the end, they rely on an equity backstop. And that is basically the same risk model as, Frax. It's not exactly the same, but it's very similar, really. And it is you can argue it's less capital efficient, of course, but it would certainly de-risk for any stable coin issuer to have larger reserves. And I think that's what's even motivating UST Terra to take on this Bitcoin reserve. I know Frax is exploring other L1 reserve assets as well. And at Vault, we aim to fall squarely on like the least risky part of the spectrum where there'll be a 20% reserve in the system. So even if there was a 20% loss in the total PCV, Vault would remain fully backed, or there'll be multiple years of runway, even if the PCV was not earning any yield, to be able to match inflation.
So you brought up both of you brought up the word yield. How's that generated? How will you keep up with inflation, Kirk?
So the main thing to understand, I think, is that it's not possible to always outperform inflation on chain. And that has to be acceptable in the model for it to work. And almost every early stage crypto protocol is actually operating at a huge loss if you take into account the value of emissions compared to the revenue. So it's normal for any early stage thing that's bootstrapping to have certain costs to do that. And so our priority is risk minimization and ample runway. So all Volt users can be assured that they can look and say, there's this 7 months of runway, even with no yield being earned on the PCV. So during that time, I'm completely secure. And worst case, Volt would just, if Volt did fail, it would just cap any further price increases and everyone could redeem for that value safely. So safe failure modes are very important in our design philosophy. But, now turning away, we're not going to talk about failure here. What we're interested in is expanding onto additional new yield venues. So I've spoken publicly about integrating with Maple Finance, for example. In the launch state, the only yield venue is the Ferrari DAO Fuse Pool 8, where protocol-controlled Fei is deposited into. Eventually, Volt will receive other stablecoins into the backing and expand into additional yield venues and opportunities. And we all know that crypto ecosystem is experiencing secular growth, and there'll be more and more opportunities and changing market dynamics. So there's no fixed treasury strategy, but it's about being risk minimized and gradually expanding the capacity to grow yield and ultimately significantly outperforming inflation over the longer term. A few months of inflation yield is not the primary concern. And that's one reason we're doing a guarded launch with a cap supply.
Can you talk a little bit about what other stable coins that you'll be looking to mint from in the future, or is that late to be discussed later?
So the number one consideration for us is the available yield, not inclusive of token incentives. So we're looking for highly scalable and sustainable yield venues for onboarding. That's one reason we're excited about Maple Finance. And so for that, we're looking to USDC for an integration. That's the top of the list. Other than that, we'll see how things go.
Okay, I appreciate you talking to that, because I mean that was one of the things I was thinking about is in preparing for this is a depegged other stablecoin and what impact that could have on the success of the protocol. Sam, you meant. Oh, go ahead. Sorry.
Oh, I was just going to say absolutely, and I think that's one of the reasons for the necessity of reserves and why even things like MakerDAO and Frax both hold a lot of USDC. We all know that there's not a 0% chance of that peg ever being disrupted, but that's one reason that the governance token backstop exists as well. And so for Volt, we're trying to be a little more proactive and have a surplus built up in advance. And more than one stable coin within the backing is also advantageous. And I think this will be the case for FPI as well, that it'll be diversifying its backing, and Sam can speak to that more as to what exactly that will entail, but ETH and potentially other things that will present a diversified risk exposure.
Yeah, so that's a good segue to how we think about it. Kirk is totally right. Like the way to actually kind of think about the consumer price index and just like what it actually is like we as like human beings in a society, there's a bunch of stuff that we think is valuable, like in and of itself because of its actual utility, right? Like food, cars, electronics, things like that. There's no one can coherently argue a car is a Ponzi or something, right? Because it actually just has utility in and of itself for what people need to use it for, right? And so the way to kind of think about uh, the FPI or any of these currencies that are pegged to a basket of items, which to be honest loosely is the dollar until kind of recently, which it's like the way that I actually think about the inflation rate is how much is the dollar depegged, right? That's basically the other way to think about the inflation rate, right? But overall, for these things, for currencies, for modern currencies, which are pegged to things that people care about, you need a way for the collateral, or essentially the contractionary lever that you have, to at least grow as quickly as the economy, right? As quickly as, for example, if the U.S. GDP was actually growing at a rate similar to inflation, like actual GDP, not nominal growth, because since GDP itself is measured in dollars and the dollars are inflating, you'll actually get GDP growth that's non-real GDP growth, because the units of GDP is going up because the dollar is inflating. But if you actually get true real GDP growth on the rate of inflation within like an economy, you can easily tame inflation, right? You're literally producing the assets that the currency is pegged to at the rate that it's depreciating. You actually can produce more cars, right? You could bring down the price of cars. You can actually produce more food. You can bring down the price of food. You can produce all of this stuff that your currency is actually pegged to, and bring down inflation. The issue is when you can't, right? So the issue is when the entire world's like closed down because of a global pandemic or something, or there's a bunch of other issues like supply chains and stuff, and you can't actually produce the food or cars or any of these things, and their prices are rising against the currency that's supposed to be pegged to their price, right? And so the way that we think about the FPI is not a yield product or like a yield business. We have just a completely different scale vision of like what we're trying to do. This is not like a urine vault of like, oh, like deposit your thing in here and mint some yield thing, and will protect you against inflation. Yes, that's part of the actual usage, but that's not the reason we've been building the FPI for months. And I always say I think it's the successor to the US dollar in terms of unit of account. And if it is, the way we have to actually think about it is like how the dollar is structured, not as a yielding business that's like losing, losing yield or something, or like subsidizing its growth or something like that. The way you have to think about it is, if you're going to build a brand new digital, non-custodial, totally decentralized currency that's pegged to a basket of consumer items, how can you make sure that the actual economy that's using this thing is also growing at minimum at the rate of the current inflation rate, right? And that's how we actually decide, how to do our reserve, the collateral breakdown, how to actually put it to use, or what to actually intake, right? Like the L1 tokens that Kirk was talking about. But the way to look at it is as like a central bank, because literally this stable coin actually is a different, peg entirely, rather than a dollar. So it's not so much as, you know this is like a small little business or like a project, and it's like losing money or something. How do you make sure that there's actually profit or something? It's actually a different scale than that. And I think this is actually a common theme in crypto, where there's like the traditionalists and orthodox people that are like very, very traditional finance oriented, and they look at things in like the view of, oh, like I subtracted the revenue from, the costs, and this project is like losing money, therefore I'm really smart, and I know this is not going to work out, and then I'm going to write like a Twitter thread about it or something. And then there's the kind of other side of it, which is like they don't actually look at it in traditional financial speak, which is also bad if it's too far in the other direction, because then you get really unsustainable and bad things. And then, people use that as evidence from, the traditionalist orthodox people use that as evidence that, they were right all along. But there's just this common theme in crypto of like things that look like something that are actually something totally different. There might be something that looks like a losing business, or like an unsustainable thing, but it's actually not even trying to be a business or something like that. It's trying to actually be something completely different. And so the views and valuations of applying a business thing to it completely are nonsensical. A good example of that is Bitcoin, right? Like if you think of Bitcoin as an actual company, right? Like what is Bitcoin? If BTC is the things that, are the closest thing to equity, like Bitcoin is the world's most loss like business that has never ever taken any revenues and never will, and all it will ever do is issue its equity out and lose. If you do a orthodox view of Bitcoin, it is the world's worst business in the history of mankind. It's actually never going to earn a profit. But then if you look at how Ethereum is structured, it kind of is a business, and it is actually starting to become profitable. So you have to actually decide what kind of view you want to actually look at some of these projects. So with the FPI, I kind of try to issue the view that, oh, like how do you subsidize the yield and then like go and yield farm with the collateral or something like that, because it's not even like kind of a in scope question in my opinion.
That's a really interesting point, Sam. I'm sorry to jump right in, but I just wanted to add that I really agree. And that one thing I would just advise to all listeners out there is that labels usually do more than to deceive than to reveal in DeFi. And things like decentralized versus centralized, or over-collateralized versus under-collateralized, there is real meaning there to some degree, but you have to evaluate each specific system and project on its own basis and understand what's really going on. And that takes, some serious effort. And looking under the hood, and they're all very interesting, and their risk models can get pretty complex, even familiar ones like MakerDAO.
So, as a small-time retail investor, and Sam, you touched on this a little bit, but I'd like to dive a little bit deeper on the understanding of the differences. I can take Frax, put it in Curve, deposit in Curve, and then stake in Convex. Never Yearn, but definitely Convex. And I can earn that yield similar to what FPI or Volt would have percentage wise, but I have to pay gas to collect. There's probably some tax disadvantages to have it set up that way versus having Volt or FPI. But talk to me as a small retail investor. What's my use case? What am I going to use Volt for? What am I going to use FPI for? And what's the advantages versus staking it in Frax and Convex?
Yeah, basically, the really cool thing here, at least in this macro inflationary environments, like you can just hold FPI and Volt as their pegs are what the current definition of inflation is plus the dollar, right? So it's basically like holding a dollar stablecoin plus internally it yielding currently, what is it, between 8 to 9%, which is pretty incredible, right? It's probably actually better than a lot of stablecoin farms, right? Obviously, that rate is variable every month, right, based on the CPI Oracle and the CPI report. But the really awesome thing here is that this is almost like a savings account in a token in this environment, right? Like you can just hold FPI and Volt in your wallet, and it will actually grow in purchasing power compared to DAI, USDC, Frax, FEI, and all the dollar pegged stable coins. Now, there's obviously going to be additional yield in terms of staking or even LPing this stuff and earning transaction fees. Like, for example, we just got a FPI Volt Uniswap V3 pair on a tight range, and now I'm actively working on getting the FPI Volt Stable Swap curve pool up, and there's additional yield, right? Now able to have deep liquidity at the peg. This legitimizes the peg. This makes it extremely profitable for people to LP and trade. Some of the dollar pegged stablecoins themselves at an extremely tight range on Uni V3, for example, get 5 to 6% APR just based on fees. And obviously, everyone knows on Curve, it's everyone's favorite place to LP stablecoins, both in terms of fees and awesome yield on Convex. So once that's up with FPI and Volt, there will just be additional yield on top. But the coolest part about this, I think, is if you bridge FPI or Volt to L2s or even other Alt L1s and things like that, you don't even need to set up any kind of stablecoin farms or anything like that. You can kind of export this new currency to different economies, right? Different networks, different chains, and people can start using this as like a tokenized savings account. All you need is to just hold the token, and that wasn't possible before, right? You only had dollar stablecoins. So it's actually going to really change the game for how people save on the blockchain, which is really cool.
One additional venue that I'm very excited about in relation to that is centralized exchanges. Of course, we're all decentralization in favor of decentralization here, but there's a lot more people who are holding Bitcoin or ETH or who knows what else, USDT on a centralized exchange and have no idea how to use a hardware wallet. You don't want those exchange operators manually, operating in DeFi and depositing in, auto farming and dumping in different yield venues. But having a yield bearing, or at least stable value, real rate of return zero asset that can be just ERC20 plug and play is a much easier for a mass adoption. So it's something that we're excited about.
So I've been asking all the questions. Alejandro, what do you have, my friend?
I've been personally requested to ask Sam and Kirk more on an L2 topics and more retail focused questions. So I'm really glad that they brought it up because I already had a few people DM me if when I announced that we're gonna do this podcast, if it was gonna be on L2s or how long will it take. Obviously I don't work for you guys, so my knowledge is limited, but I'm really glad you guys started going into that because I could speak for as a fellow retail user, a lot of people are interested in the product, especially with the inflation with the reports coming out. So I think one thing that would be really good, just because I'm pretty sure I'm going to get DM'd about this as soon as this is over. Are you guys already planning stuff for L2, or is that like you don't even have any plans yet? Just to clarify to anyone in case they ask in the future, so they can
We
know like, the roadmap.
deep plans for L2 and other chains, right? I think actually one thing we're proud of at Frax is I believe we're the most multi-chain stablecoin in the entire industry in terms of stablecoin that is natively issued and mintable and redeemable against the protocol's value on other chains. We're around 12 different EVM chains, L2s, and everything. And so obviously we're definitely going to take that kind of multi-chain ethos to the FPI.
For Volt, we're somewhat more conservative in our multi-chain approach, but very excited about Ethereum L2s. We're working, first of all, just on being able to bridge Volt itself, the stablecoin, to Arbitrum and Optimism so that we can seed protocol-owned liquidity there. And direct issuance and redemption would come later. But given that the amounts and the volumes are not as high, and also that others will be able to mint and bridge over there as well once this is open, will, I think, work out pretty well for our first step. And we're working on finalizing a timeline for that in the next week or so.
One thing I want to ask is, do you have another question? Because we have requested, I think someone wants to ask Sam and Kirk a question.
Yeah, we'll bring them up. I do have one quick question while we're bringing them up on stage. Tie us back to Convex. Sam, I know you're viewed in the Convex Discord and in the community as somebody who's stayed one step ahead and have played your game of poker really well on positioning Frax. How are these inflation-resistant stablecoins going to play out in the Convex ecosystem? Volt, will you be purchasing some Convex? Will there be some bribes coming from y'all, Kirk? But talk a little bit about that, please.
Yeah, definitely. I try to live my life with the ethos of the skate to where the puck's going to be, not where it's going right now. Right. That's what I I'm always thinking about it. Like I'm like, okay, where is the direction that the stablecoin industry or even crypto itself is going? We started working with Convex as I think their first partner, honestly, in like May/June of 2021. We started accumulating CVX before I really want to say before any other protocol, and we started building that deep relationship because of the way that I just saw the how the entire Curve and Convex ecosystem works. I always saw Curve as kind of a not just a DEX, but kind of a savings account of sorts, and then Convex is kind of a turbocharger of kind of an active manager of that savings account. In fact, my personal belief, so this might be like a individual take, obviously, but my personal belief is that there will have to be some kind of interest rate applied to LP exposure on AMMs in order to actually have the AMM protocols accumulate liquidity. And for example, Curve is always one step ahead of the game in this. And like I was saying briefly before, there's like a lot of orthodox or traditionalist view of Curve as like a business, and they're like, oh, there's so much CRV emitted versus the fees that they're earning. This is clearly like a Ponzi, or this is like super stupid or whatever. But then they don't, for example, think about how Bitcoin is so stupid, right? Because they don't consider Bitcoin an actual business. So like they totally miss the kind of structural changes that's coming, right? And so that's why, for example, I saw that last year, and so that's why it made so much sense to make sure that we have a very, very active and currently largest representation in this ecosystem, as everyone else kind of bickered whether Curve is even a good business or not, and they fail to ask, is Curve an actual business, or is it actually something else? Is it more similar to Bitcoin rather than Coinbase or like some kind of exchange, right? And we plan to go really hard, obviously, on FPI integration in Curve and the Convex ecosystem. And there's already an FPI Frax Curve V2 pool, so that there's entry exit liquidity into dollars. And then we're working actively right now together with Kirk and the Volt guys to get the Volt FPI stable swap pool going as well with a gauge, so that people can create, a CPI based savings account, right? And get that Curve CRV CVX reward rate. And then hopefully if Kirk and the Volt guys also want to pitch in VCon rewards to that pool, we will also put up a gauge of FXS rewards, so that this could basically become the god tier of all savings accounts, right? The two LP tokens are CPI resistant, inflation resistant CPI pegs, and then the reward tokens are CRV, CVX, FXS, VCon, and that'll be insane.
I'm in.
That
Okay.
sounds absolutely amazing. As soon as that comes out, I know for sure everyone's gonna be flooding to that pool.
One thing I wanted to shout out is how much I like the Frax concept of the AMO, or the algorithmic market operation. And so besides, one of the great things about being a stablecoin issuer is you can make your own liquidity. And part of the reason that stablecoin issuers still pay incentives out to Curve is to incentivize holder demand, like Sam's saying, right? Essentially applying an interest rate to the LPs while also doing the extra work of providing liquidity. And we might flip that around a little bit and be more interested in deploying surplus funds as a protocol ourselves, and potentially alongside of liquidity incentives. And one thing I wanted to note is when people analyze like the economics of Curve, you can see, right, like sometimes, $1 in bribe produces more than $1 in Curve emissions, sometimes less. And so a protocol should have like a strategy that's aware of this, especially depending on the extent that it's participating on its own in the pool. So there's a lot like I need to understand and model out a bit about that, but we're definitely thinking about deeper integrations than just giving rewards, but actually deploying some protocol funds into Curve or other AMMs. We've seeded a little bit of liquidity on Uniswap, but a deeper strategy will be developed and publicized soon.
Great. All right. So we had a couple people join us, pulled them up on stage, and people, if more individuals want to come up, just ping me with a request and we'll pull you up. But let's go ahead. I think, is it Chloe?
Yes. Hey, good evening. Or good day. Yeah, thank you for hosting. Very interesting and big fan of the Frax. Yeah, very good talks. Sam, big fan, and I just want to say that I'm representing yield farming, one of the biggest yield farming platform. Would love to have you for AMA if it's possible. And myself, I'm a youth farmer, and also that I am representing like DeFi woman, because when I first started I got scammed, so it was a horrible journey, and thank God that I stick around. I learned hard, I study hard. Now I'm working with DeFi, very grateful. So wanted to be useful and helpful, helping other girls who wants to learn about yield farming, DeFi. So yeah, that's what I'm doing, and also working for this yield farming platform. We are an educational platform, one of the biggest, as I mentioned, and yeah, we are. I am very big fan of what you are doing. I would love to have you. So if it's possible, I would DM you, please. Yeah, if that's
Thank you.
good.
Thank you for that. That means a lot. Sure. Definitely.
Yeah.
Feel free to reach
Thank you.
out. And I think
Yeah.
there's no better yield farms than these ones that are coming with FPI and Volt, right? So
yeah, exactly. Yeah. Also that okay, I want to ask you guys a personal question. This will anybody is welcome to respond. So as humans, I don't know how you feel, but myself, I feel most of the time I'm very, like, it is overwhelming. There's a lot of stuff happening, and I'm basically 24/7 literally, because it's so much to learn. Still, I am working with it, but still I could feel the imposter syndrome. if you know what I'm talking about. So I'm wondering if any of you facing this, how do you deal with it? Thank you.
Well, I'll just take this moment to give a shout out to the tribe, because there's a big difference between, it's been over a year now since I quit my old job and set out to try and build Volt. And certainly there was times of being lonely or uncertain along the way. But since I started to work with the Tribe DAO, and especially with my now co-founder Elliot and Joey Santoro very closely, and the other people there, that all changed. And being able to bounce ideas around closely value-aligned people on a day-to-day basis, and also the more extended circle, here on Twitter, and who we have voice conversations with, but being able to meet in person and to work together with people who have a long-term vision alignment really makes a difference and sets the mind at ease, especially when you know that someone as smart as Joey is looking at the code.
Yeah, I mean, the most important thing is actually just making sure you're having fun with it, right? Everyone always asks me like, what gives you motivation to build this or that or whatever? Like, are you, do you want to retire on like a island or like sip mojitos all day or whatever, or go and have a good time like that or whatever? And it's honestly just because it's fun. This is my definition of fun, and it's not even really. Uh, Sometimes I say this is all I know how to do, and I love that this is all I know how to do, because this is how I have fun. I have fun basically geeking out on modeling economics and mathematics and crypto economics together. And so as long as you always take a step back and ask yourself, like, is this actually in and of itself fun for me, or is there some kind of end that's like the real reason I'm doing this? And usually that question will help you kind of understand what meaning you're gonna get out of this. And the reason I'm always super into this stuff, and I'm doing it 7 days a week, 24/7, is it's actually what I find valuable and meaningful and interesting. So that's always a question that helps me.
Yeah, we wouldn't have it any other way.
Thank you so much. Yeah, very well said. Literally, like I think passion plays a big role, because we are passionate about it. We see the future. We know where this is going. We know how important this is. And that's that what drives us to do this 24/7. But at times, I always feel like, oh my God, there's so much. I'm not good enough. How can I do? Sometimes I wish I could just open up my brain and pour in all the knowledge. That's how I feel. And at times can be very stressful. And I think just be gentle, be kind to ourselves, and just keep going, I guess. Thank you, guys.
Yeah, thank you for the good question.
And one way to force yourself to learn is start a podcast. Alejandro, that I reached out to you, and one of the first things I said was, man, I want to learn more. I want to know more. Would you be interested in doing a podcast with me?
No, yeah, definitely. At least this is my own way of forcing myself to go learn more. I enjoy this space and everything, but but before every interview, before every like show or whatever we have, having to do research so you don't just go in blind. At least for me, like having a little hobby, a little side project, like if it's crypto related, definitely helps a lot with the knowledge and trying to get smarter every day.
Oh yeah, from that, that's a very good angle. And would you please be interested for an interview for a DeFi woman to help? Because as a woman, I noticed for guys is more like go getter. You just go get it. For girls, we are more emotions, and we have to feel good about it. There's more feeling to it, so that'd be great to have you guys come over on DeFi woman. I do have a YouTube channel for DeFi woman, try to help other girls. I think it would be great. We can talk about mindset, and to be more like how you go get it, but still be gentle, kind along the way. Something interesting?
Yes, definitely. Great topic.
Okay. I will DM you.
Yeah, appreciate your questions and your feedback. Mr. Adeline, we have you up on stage. Take the floor, sir.
Yeah, thank you so much. And I just want to say I'm really excited to fork the US dollar. It's about damn time. I'm a community mod for Vesper Finance, but on the side, I'm an incoomer for FXS and Convex, and just really excited about the continued development of all these platforms and what they can do for people. My question is really specific to lending markets, and I guess it's a little bit of a two-parter, but to illustrate, I've been thinking if I'm sitting here with some Bitcoin or ETH that I don't ever want to sell, I might go into a lending market and put that up as collateral, and I'm going to want to borrow just straight US dollar stablecoins because I don't want to borrow a asset that is appreciating above the stablecoin. Conversely, if I'm going in, and which I'm not going to do, I promise, but others might want to short, a volatile asset. You're going to want to put up these new CPI stables as collateral over the US dollar because they're going to appreciate in value, and your risk of liquidation is that much less. And that's all assuming, I guess, the interest rates are close to the same between assets. So I guess my question is do you all see some type of assuming, and I hope that these CPI stables take off, is there going to be some type of impact that you see in lending markets? Would you expect to see rates increase for the standard stable coins and what have you thought about that?
Yeah, I'll take this because it's a brilliant question. And actually, thinking about stuff like this is exactly the right mindset, rather than thinking about how do you make sure the collateral yields as much as inflation, so that we're not like an insolvent bank, or the orthodox view of this. So that's a good question, because again, one of the most common questions, how do you have the collateral grow as much as inflation? Well, as you said, imagine for a moment that there's a situation in which there is a lot of FPI redemption, right? People do not actually want to hold FPI, which is the exact opposite scenario of right now, where there's a lot of inflation, right? The reason people worry about FPI or Volt being 100% backed by collateral is because there are times where everyone wants to redeem or exit the FPI stablecoin or Volt because there could potentially be low inflation, right? There could actually be if there is actually deflation, by definition, the CPI pegged stablecoins are losing value against the dollar. I'm not saying that's likely in this current case, but those are the only times where people will come and start redeeming FPI stablecoins in mass, right? Because they would rather hold dollars, right? And during deflation, or during when inflation is going lower and lower rather than going higher and higher. Well, how do you do that? How do you actually make sure the system is solvent and can actually either one of two things, either service all of those redemptions or actually provides yield that offsets the lowering of inflation? How you do that is, like you were saying, there needs to be deep lending markets against the CPI pegged stablecoins and dollar pegged stablecoins, so that during the times where the CPI pegged stablecoins are actually losing value, or gaining value less as the inflation rate goes lower and lower, people are then able to borrow the CPI pegged stablecoins and short them with dollar collateral. And the interest rate to borrow those CPI pegged stablecoins like Volt and FPI, that interest rate becomes essentially this quasi risk-free rate on top of whatever the FPI peg is growing at, right? And so that should actually blunt a lot of the mass redemptions that a lot of people are commonly worried about in terms of, you know, asking us, how can you have 100% CR? How can you make sure you're always solvent? Is we have to work with a lot of lending protocols, with Fuse, you know, Rari, and the Tribe, with Vesper, with Aave, Compound, all of these places, to make sure that right now, while the inflation rate is high and things are good for the FPI and Volt stablecoins, there's deep markets forming in these lending protocols, so that when things go the opposite direction and people are actually trying to redeem or move to holding dollars instead of these coins, the inflation rate that's going down, there's actually going to be an interest rate for lending these CPI peg stablecoins. That interest rate is risk-free yield on top of that peg. So there's a lot of things to look at. That's not just, oh, is this, you know, protocol insolvent, or oh, and then, you know, there's no collateral here that's 100% backed and stuff. And you had a really good point about this, right? The point is, how can you be cognizant of these interest rates, which is exactly what we're thinking about from day one.
That was a great answer, Sam. And one thing I would add on to that is that, as like a very short-term example of how this would work, is that we'll be excited for Volt to get its initial collateral factor in the Ferrari DAO Fuse pool in a few weeks or a month once things are borne out. And we're also very excited about the idea of a potential gauge for lending out Frax against Volt collateral, maybe Volt and FPI collateral in the same Fuse pool. And that is a very attractive incentive target for us to consider. So like DAO to DAO borrowing, like where MakerDAO does the D3M into Aava, and Compound and deposits, and essentially, like, this is what like banks do, right? Central banks lend into smaller banks or riskier, and, you know, commercial banks lend into riskier banks. And there's all this kind of network that appears and is necessary. So that's really exciting.
Awesome. Thank you. If I could just really quick follow up, and thank you. Great answers. And I know, Sam, I've heard you talk a lot about how you have kind of looked at bootstrapping a stablecoin, and how so much of that is around network effect. And I guess I just have a question about, like, is there damage to network effect by basically kind of what we're talking about is having both, you know, supported, incentivized straight USD stablecoins and the FPI stablecoins, or do you see them as like, you know, kind of like self-supporting each other?
Yeah, I mean, I'm probably most known for always saying to have a positive sum mentality in everything in terms of stablecoins. And I always want Frax to be known for, if there's one thing, is that we're very, very collaborative, and in fact try to actually expunge the word competition or zero sum from anything that we say or even do internally as a team. I don't think there's such a thing as competition or like zero sum, unless the other project actually comes out and they are hostile in terms of, like, you know, we will take your market share, or we will do this or that. And the only example of that I've encountered, actually, coincidentally, was MIM, actually. But in any case, I think every single project that's interested in working with us, and that's why it was so exciting when Kirk was like, we're also going to do a CPI peg stablecoin. I immediately said, this legitimizes this peg. This makes this peg a Schelling point where people can have deep liquidity and actually rally around, right? And it actually makes both stablecoins better that each other exists. So I've always had that mindset, and so that's how we always build everything at Frax.
Yeah, absolutely.
Cool. Thanks so much, guys.
I would say, like, I was just going to throw out there, if you see in the banking world, like, you know, obviously there's not just going to be like one or two stablecoin issuers, just like there's not one or two banks. So it's critical to have relationships and ability of trading of risk and liquidity and that sort of thing.
Yeah, I just wanted to jump in as well. I'm doing that community stuff for Volt, but like massively share Sam's sentiment on that. I think a lot of people don't realize that, because we always get that question of Volt versus FPI always comes up a lot, but really, it's like we're at such an early stage of stablecoins and experimentation, especially in now the CPI thing. It's like a whole new ball game, and it's like in terms of there's more than enough like total addressable market for for heaps of competition. Like there could be tens of different CPI backed stables, and we would still have like billions of dollars of market cap to take up. So I think it's just like so early that working together to try and push the space forward as quickly as possible is worth way more than fighting over this small piece of the pie.
Great additional information. Alejandro, did you have any final questions?
No, just to give my final thoughts as we have another person that wants to speak. But let me really quickly say this piece and then I will add you as speaker. But no, I definitely agree. Like cooperation and try to rise up. I don't know if rising is the best word, but like try to grow and rise together is a lot better than like fighting each other. And generally, of course, I'm not in the background. I don't know what Sam and Kirk like do in the respective protocols, but I generally I find it really hard to see like the long term. The majority of the time, DAOs are probably just going to work together, try to grow together because they like everyone would benefit and anyone would benefit from that. At least from the year and a half that I've been in crypto, I generally see more cooperation than hostility towards each other. At least in DeFi, L1s are a different story.
I think it's more like a sports teams kind of friendly competition, if anything. Like I obviously can't speak for other protocols, but most projects I've worked in, Vault included, it's like you're always watching what everyone's doing, and except it's good to have people doing the same thing so you can be watching, and it really drives you forward, as opposed to if you're the only person in a space, then it can get a bit stale.
Well, we're running close on time, but let's get that one more question in. I see a friendly shroom.
Hey there. I just wanted to ask, has there been any talks in terms of FPI and Volt inside of the diamond-handed Olympus Treasury?
Yes, I know Kirk has probably been talking to Olympus, and we love Olympus. I think again, like back in 2021, I think we're one of the first partners together with Frax, right? So would absolutely love to do some kind of very, very big thing with you guys. Again, in fact, I was like talking to Zeus a little bit. I think Kirk feels the exact same way. So let's do it.
Sweet.
Yeah, absolutely. We're like finalizing all the plans for what our VCon token launch will look like, which is obviously important for how things go with both the public and DAO treasuries. And so once we have all those details, we want to make like, certain special opportunities for our partners and the long-term aligned entities to be able to, get additional VCon in exchange for holding their Vault as well. So once we are kind of ironed out on those plans, we want to bring it to the community.
Yeah, for sure. I mean, I just feel like there's such great alignment between, CPI track stables within Olympus, given that, a heavy amount of stables exist in there. And, it's probably just a good idea, not only to start to accumulate some of that for, risk-free backing, but, also to, in the future, potentially diversify some of the stables that we already hold on to. Into things that are not melting ice cubes.
All right. Well, we've gone a few minutes over, but appreciate the speakers we had join us, the questions from the audience, the community. Appreciate Sam and Kirk, you guys joining us. It's been an honor to host you at the few weeks into our podcast. We're excited to have future conversations with you all. Alejandro, any final thoughts? And we'll shut this down.
No, yeah. I guess just personally for me, like, thank you for getting on. And I know the Convex community was really excited when I announced that we were gonna do a podcast with you guys. Thanks for coming out and doing that. And I just wanted to say, like, before we close, is there any last thing you want to plug before we end the recording? For both of you guys, any announcements or anything you would like to have out there before we close this off?
Just a quick reminder to keep an eye out for an announcement next week regarding the opening of Vault minting on Fuse, where you'll be able to borrow Vault against collateral, which was delayed from the original launch. Right now, it's only mintable in the peg stability module.
Yeah, and thanks for having us on. It's always a pleasure. Mint your FPI at the Frax app.frax.finance, and thanks, guys.
KingMaker Podcast.